and welcome to the Maine Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, and I am joined today by Jordan Main. He is president of Maine Financial Group, as well as joined by Adam Freund. He is certified retirement counselor. To our viewers at home, we have a very fun and exciting topic. We're talking about taxes and retirement. Don't turn the channel, stay with us. This is very interesting. But we have to talk about it.
Absolutely, 100%.
Well, obviously, gentlemen, let me ask you first of all, how are you both doing today? Adam, how are you?
I am just wondrous today.
Wondrous. That is fabulous. I am doing great as well. And Jordan, how are you?
Oh, I'm excited today because today's topic is close to my heart.
It is. And we can talk about why that is, because obviously taxes in retirement, there seems to be this misconception that taxes go down in the retirement years, but that's not necessarily true. And Jordan, you're very passionate about something that we want to talk about for sure. Tax planning versus tax preparation. Is there a difference, and how so?
Absolutely. In the simplest form, tax preparation is looking in the rear, summarizing what happened over the last tax year. You can't really do anything to change that. Whereas tax planning is looking forward to implement some strategic maneuvers to reduce that tax bill, because the last thing we want to do is give extra money to the IRS.
And how important is tax planning overall in the retirement years?
It is probably one of the biggest things that can derail a retirement plan, not planning for taxation. Because if you think about it, all of these retirement accounts that we have are essentially IOUs to the government, right? The pre-tax accounts. And as we kick the can down the street and these 401ks and IRAs get bigger and bigger, the IRS is just sitting there waiting to collect their piece. So an efficient tax strategy in retirement will make a major difference.
Well, Jordan, we all wake up being passionate about something, but let's talk about why you are so passionate personally about tax planning.
Sure. So right out of college, I was with a tax firm as a certified tax accountant, and I learned to despise stockbrokers. And the reason is we would share a mutual client, and the broker would get our client to buy and sell and never talk to me about the tax implications. And I had to clean up the mess, the tax return.
Oh, boy.
So as the client, I would tell the client, go back to that broker of yours and tell him to knock it off or at least do some planning. And what is the typical response a broker says when they ask about taxes?
Oh, don't ask me. Go ask your tax professional.
I'm not allowed to talk about it.
I'm not allowed to talk about that.
So the clients came back to me saying, well, there's nothing we can do. And that's really how I decided to get into the industry. I said, out of spite, essentially, I need to bring a tax planning into a retirement investment strategy and marry the two together.
Okay, and I know your clients love that about you because it's very important, as we know. Adam, so much so that when you think about it, by proper tax planning, you can actually reduce your tax bill in retirement. I want to ask you, let's talk a little bit about that, because sometimes your withdrawals from your accounts are taxed as income, correct?
That is correct. Most of the people out there don't realize that their 401k, their 403b, their IRA, all of those, you have a nice old uncle called Sam, and he is going to take out his portion that is due to him. You had the ability to save all these years tax deferred, and that's the key. It's tax deferred versus tax free, which Jordan is one of his favorite things to do with our clients as well, is to get them into tax-free vehicles.
Absolutely, because when we spend our whole life working and saving, we actually end up with 3 different types of accounts. Let's talk a little bit about that. The first one would be the taxable accounts. Jordan, can we shed some light on what taxable accounts would be?
Absolutely. So taxable accounts are the accounts that you've, let's say, paid tax out of your paycheck and deposited it into your bank account. Then you decide maybe to buy a CD with that money, and at the end of the year, what do you get? This friendly little 1099 INT. And you have to now pay tax on the interest you made. So you pay tax to get it into the bucket, and now you pay tax every year. Or maybe you buy a stock and you have a dividend tax, or maybe you buy and sell stocks and you have a capital gain tax. Any way you look at it, this box is called this bucket is called the double taxation bucket, kind of the gotcha bucket. Okay. It's also referred to as non-qualified, meaning it doesn't qualify for any special tax treatment.
Okay, okay. And then the next one, Adam, let me ask you about this one. We have this is the one that most majority of the Americans have. Let's talk about why this is important, the tax-deferred accounts.
Right. As I mentioned earlier, these are pre-tax dollars. You got to essentially reduce your income for that year by putting money into a 401k, or you got a tax credit for putting your money into an IRA.
Okay.
So those grow tax deferred, meaning that whenever you're going to take that money out, you're going to be taxed, but you're not going to be taxed at capital gains. You're going to be taxed as income.
Wow.
So that means that if you're earning a certain dollar amount, just by taking income from this, you could shoot up to another tax bracket. So we don't really want to see a lot of people be in that particular bucket in retirement.
Those buckets are essentially big IOUs
Yep.
to the IRS,
Yeah.
or we call them tax bombs as well.
Yes.
So there's a lot that goes into strategizing how to maneuver out of those.
So basically, qualified accounts means you're qualified to pay taxes. Yay, lucky us.
I like that. That's a great
Lucky
one.
us. Oh, my goodness. Well, let's talk about your favorite, Jordan. Let's talk about the tax-free. I want to
Sure.
spend some time on that.
So the tax-free vehicles are great. They go into the accounts after tax money. You don't get any deductions or benefit up front, but then they're never taxed again. So anytime you hear the word free and the government, there might be some limitations there. So all of these different things, like you've heard of a Roth 401k, a Roth IRA. Another one is what we call a LIRP, a life insurance retirement plan, which is just an overfunded life insurance program that you can draw cash out of. All of these things have limitations to get into them and stay within them. But if you can stay within those boundaries, they become a powerful tool in your retirement. So we use the verb in the office of, can we Rothify your retirement account?
I like that, Rothify. So would the 529 education account be in that grouping as well?
It
Yes.
would be, and it would qualify as tax-free. Now, the issue is if we don't use those funds for education and end up withdrawing them out, then there are some tax issues with that. But as long as you use them for what they're meant for, education, then we're good with no taxes.
Are people often surprised to learn that their tax trajectory is a little bit different after sitting with both of you and going through tax planning?
Oh, absolutely.
Yeah.
I would say shocked at times. We have to really put the nose to the grindstone and make sure that they understand the implications of using taxable dollars, taxable income dollars for purchasing things, or even taking it out just to cover certain expenses, as I said earlier, can throw them into a new tax bracket.
Well, exactly right. And that's the whole concept is managing your tax buckets in retirement is not always as easy as it sounds.
No.
And should everyone have these 3 different buckets?
I think they should and have the right amount for their situation and each. You know, back to what Adam was saying, they're shocked to see where they are on the current trajectory with taxes. And then when we come back and say, well, what if taxes go up by a few percent in each category? Then it really derails things. So I'm a big believer that tax planning is probably the most important piece of your retirement strategy.
Now, is that why you came up with this, the Money Report?
The Maine Money Report
Yes.
is our favorite report that we do. It's like an MRI, a complete makeup or workup of your entire written financial plan to make sure that your strategy can deflect any of these eroding factors, and taxation is a big piece of that.
Well, this is the perfect time for us to offer this to the viewers at home. Would you agree?
Absolutely.
All right. To the viewers at home, there's a number to call. That number is 888-462-7839. As you can see by being a viewer of today's show, taxes in retirement can actually be kind of a hidden time bomb. You don't want that experience. You want to have peace of mind, and you want to know that tax planning is taking place for your retirement goals and needs. Remember, you've worked your entire life to get to the retirement years. What's more important than peace of mind? Nothing. So being offered today is the Maine Money Report. All you have to do is call in 888-462-7831 to claim one of yours today. Better still, if you don't have a pen handy or you're running out the door, you can grab your smartphone. Just click on the QR code at the bottom corner of your screen. That will take you right to Main Financial Group's landing page. You can claim your spot accordingly, and you can have one of the money reports drawn for your specific situation. We're going to take a very short commercial break here on the Main Money Show, but don't go anywhere. We're talking all about taxes and retirement. We have so much more when we return.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
And welcome back to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, and I'm joined today by Jordan Main. He is president of Main Financial Group, as well as joined by Adam Freund. He is CRC, Certified Retirement Counselor at Main Financial Group. We're talking all about taxes and retirement. We've also gone through the three things. We've talked about taxable, tax-deferred, and tax-free accounts. Now we're going to talk about something very important, tools for tax control. I like this one, Adam. This is a good one, tools for tax control, because we all want to pay our fair share, but we just don't want to pay too much.
Right.
Let's talk about some tools for tax control. But first of all, let me ask you, where are we right now in tax history?
Yeah, so that's a great question. So the federal income tax really started in the early 1900s, and can you believe it? The highest tax bracket in the early 1900s was 7%.
7?
So it didn't matter if you earned, well, back then, 100,000, 200,000, you were in a 7% tax bracket. So let's fast forward to World War II. And the Congress then passed a bill that raised the highest tax bracket up to 94%.
Wow.
Now, this is sort of known as the Ronald Reagan tax code, because he was an actor at that point in time.
Yes.
And he would do 2 movies a year, nothing more, and he would get paid $100,000 for each movie. So why didn't he do that? Because as soon as he would to earn, if he did another movie, anything over that $200,000 was taxed at 94%. But he also lived in California, and at that time, California had a 6% tax, state tax, and that meant that he would have done the picture for $0.
Oh.
So if we continue on that trip, all of a sudden, taxes started coming down.
Yes.
And during this whole time, when taxes, the upper tax bracket went up to 90%, our deficit was probably right around maybe $200 billion, which sounds like a lot, but in retrospect,
Yes.
$200 billion is nothing. But as these taxes start coming down, 84% in the 60s, into the 70s, and then all of a sudden we started getting into the 90s, taxes, I like to say, taxes are on sale right now. It's a great time to do conversions. But what else has happened is that our deficit has blown up. I think we're at, what are we at right now?
Our total debt in the over 30 trillion.
Over 30 trillion.
I think there's a debt clock that you can actually click on online, and you can see it like just keep going up. That's too depressing. I don't want to do that.
Right. So what does that mean? That means right now, this sale on taxes is going to actually end at the end of 2025, when we're going to revert back to a 2016 tax code. And that means that not only does everybody basically get a bump in their taxes, these brackets have been so huge right now,
Yes.
they're going to shrink. So it's going to take you less money to get to a higher tax bracket.
Wow, that is scary, because when you think about it, the width and the gap between each bucket, it's so drastically, it shrinks, it's a double whammy, if you will.
Huge double whammy.
Oh my gosh.
Absolutely. And then, so what can the government do when we have this huge debt, right? We've talked about their tools to try to offset that. There are really 4 things that they can do. They can print more money, which we know the issues with that. What do they call it, Adam? Quantitative easement.
Yes.
They can borrow more money, which we have done and done and done. They can cut spending, which we know is hard to do. There's political sides on both sides of that.
Sure.
Or lastly, they can raise taxes. And think about that for all of our qualified retirement accounts where we have a silent partner, Uncle Sam. The easiest thing to do is to raise taxes to begin to address this huge debt that we carry as a country. And that's a scary proposition for people that are getting into retirement.
When you think about it, there are so many people that have been saving for years in their 401ks. That is a perfect opportunity for the government to kind of take all that out, if you will, to pay back the debt that we have. So it makes perfect sense to me.
Yeah. Who was the comptroller that
David Walker.
David Walker. Tell them a little bit about David.
Yeah, he wrote a book, and he was the U.S. Department of Treasury comptroller, I think, under both Bush and Clinton, so both sides of the aisle. And he wrote a book, and he said, this is not a political argument. This is mathematical, that we're in this 30-year lull of low taxes. If you look at the last 100-plus years, that taxes have to go up. And at some point, kicking the can down the street that we're doing financially or fiscally as a government has got to change.
Sure. So what happens if someone is blessed enough to not necessarily need to take money out of their retirement accounts? Adam?
Yeah, so God bless you. I hope you're in that situation. However, Uncle Sam says, wait a minute, I still need to take some taxes out, and we call that an RMD, required minimum distribution.
Okay.
Now, for those of you in the audience that is, let's say, before 1960, I believe it's 66 and so many months where you are going to have to start taking your RMD out at age 73. Or is that, no, that's not correct. For those of us, that's correct. 73 is when you're going to have to start taking your RMD, required minimum distribution. Now, my dad thought, oh, I have to pay the government, if I have to take out an RMD that year of, let's say, 4%, I'm going to have to give the government 4% of my portfolio. No, no, no. You have to take that as income, and you're going to pay tax on that 4% that you withdraw.
Okay. What happens if you forget to take your RMD?
Oh, boy.
Yes. Well, let's say you're
Just curious.
You're out of town, you're on vacation, you rent a house down in Florida, which a lot of us Michigan snowbirds do.
Yes.
And you forget. Well, Uncle Sam doesn't forget.
No.
They hit you with a tax on what you missed, what you should have taken. And then they say, well, wait a minute, we're going to hit you with that tax, but we're also still going to hit you with the income tax on what you should have taken. So when you link those two things together, depending on your tax rate, it's upwards north of 70% they would clip you for. So it is imperative to have a strategy built into your financial plan addressing RMDs.
Which we do in our office. We make sure that nobody misses an RMD.
I should ask you, Adam, with everything that we're talking about today, what negative effects can be triggered by everything we're speaking of?
Well, like we talked about before, a raise in your income can cause real problems in retirement because, you know, it used to be that you would think that by the time you got into retirement, well, my income is down, therefore I'm going to be in a lower tax bracket. But and that could be true for a while, right? But then all of a sudden you hit that 73, 74, and you having to start take RMDs out. Oh, wait a minute, I'm earning too much money. Not only that, if the government raises taxes, you're going to be in an issue where you are having to take your retirement money just to pay Uncle Sam.
Oh, and does that affect Social Security as well, Jordan? Taxes on Social Security?
Oh, it does. So this is a big question that we get all the time. Do I pay taxes on Social Security? And my answer is yes and no. Right, so Social Security is taxed. If you look at the front page of your 1040 tax return, your gross Social Security goes in the middle. And then a portion of that is moved over to your column of taxable income. And it's totally based on the other sources of taxable income that you have above. So those that don't have any taxable income get Social Security tax-free. Those that have taxable income pay a percentage of tax on that Social Security.
Wow, all of this information is so important and so key, especially when it comes to retirement planning. And this is the perfect time for us to take a commercial break, gentlemen. Would you agree?
Absolutely.
To the viewers at home, we know that you've heard a lot of information today about tax planning, and you're asking yourself questions. Do I have the right tax plan for my retirement years? Am I going to be okay? What happens if the government decides to increase taxes? Will my bracket go up? What happens to my Social Security? The number to call in is 888-462-7839. And what you're calling in for today is a copy of this, the Maine Money Report. What this is a customized plan that's going to be created for your specific needs in retirement. It will encompass your tax planning as well as everything else that has to do with retirement. You deserve to have a holistic, written retirement plan that's going to address all of your dreams and goals in retirement. You deserve to have peace of mind. Again, that number to call in is 888-462-7839. But if you're in a hurry and you're running out the door, just grab your smartphone. We've made it even easier. Click on that little QR code at the bottom corner of your screen. That will take you right to the landing page for Maine Financial Group, and you can claim your spot with these gentlemen accordingly. We're going to take a very short commercial break. Don't go anywhere. We're talking about taxes in retirement. Stay tuned.
When was the last time you saw your financial professional? Are you getting the most out of the strategy that was created for you? Although you've done a great job finding someone to help plan for your future, are you 100% sure that you were given the right strategy? We can help answer these questions and more with a complimentary second opinion evaluation. We will take a look at what you have in place and then help determine if you're well positioned to get the most out of your future retirement income. In the event that it is not, we can help by making suggestions and showing you how to get on the right path. You wouldn't get just one opinion when it comes to a major health decision, so why would you treat your most important financial decision with such disregard? Call today for your no-cost, no-obligation second opinion evaluation to see if you're getting the most out of your retirement income plan.
Welcome back to the Maine Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, and I'm joined today by Jordan Main. He is president of the Maine Financial Group, as well as Adam Freund, CRC, Certified Retirement Counselor for Maine Financial Group. We're talking all about taxes in retirement. We know it's not a very fun subject, but it's very important. And so in this segment, we're going to talk about one of those tools in the toolkit, if you will, one of our tools, the Roth conversion. Jordan, let's talk about that, how that can be beneficial for retirees overall with tax planning.
Absolutely. It can be transformative in the retirement plan. So I'll tell you a story about a client that we had come on, and we'll just name him Rick in this example. But this was several years ago. Rick came to us and said, this was when here in Metro Detroit, the big three, Ford, General Motors, and Chrysler, wanted all those pensions off of their books because people are living longer and they can't meet those guarantees provided. So you could roll your pension over to your own IRA and then also combine your 401k into that.
Okay.
And then have control of your own asset. So Rick comes to us and says, I've taken the lump sum pension rollover. I've also added my 401k to it. I now have $2 million in pre-tax money. And like I said, this was several years ago, and it happened to be an election year. And Rick had some ideas that he thought the election was going one way. He says, I want to convert all of it right now in this year. All $2 million, meaning that it's all taxable income
Oh my.
to Rick. We said, please no, let's try to do that over time. And he said, absolutely not. So we went ahead and we did it. Now, he paid about $900,000 in tax that year. So he had about 1.1 remaining. And then he came to us with a great idea that I want to put this in a very risky stock investment. And we said, Rick, wait a minute.
Yeah.
You've already taken a major hit with your taxation. Let's be a little more conservative in the strategy. And he had an idea that this technology was going to be a great space to put all the money. So again, against our recommendations, this is what the client wanted. We do customized planning. And so he took extra amount of risk on. Fortunately, it worked out for him. Technology went up for a nice amount of time. And he not only recovered all the money that he made, he went in north of what he started with. And remember, now it's all in. a tax-free vehicle.
Wow.
So now Rick is pulling out about $200,000 a year in our retirement strategy that's in a guaranteed income streams for the rest of his life. Also, him and his wife are taking out Social Security.
Okay.
About $30,000 each. About $60,000 in total. Remember what we said earlier in the last segment about how is Social Security taxed? Social Security is only taxed based on other forms of taxable income.
Okay.
Where does a Roth IRA show up on your tax return? Not on the front page of your 1040.
Nope.
So Rick and his wife are collecting $260,000 a year and not paying 1 penny of income tax. Now, on the flip side, my mother, who's a retired school teacher, who lives on a pension from the state of Michigan and Social Security, pays tax on her Social Security. Sorry, Mom. But
She's calling in right now.
a pension is taxable for life. And so my mom will always pay tax on her Social Security. So Rick, not only did he help his situation on his retirement accounts, he also eliminated all tax on his Social Security by maneuvering buckets of money.
You're a lifesaver. You really are. I mean, what an amazing plan that you crafted for him. But I have to ask you, we only have a couple minutes left. Is a Roth conversion right for everyone?
Everyone's situation is different, so the answer is no. You have to look at your individual tax bracket, your individual income needs, your individual risk tolerance of how you want to set things up. But that's part of why having a written financial plan is so important and what we do in the Maine Money Report.
Which is so important. So obviously we have the tax rates being an unknown. So Adam, let me ask you, in your opinion, taxes going up or down in the future?
Oh, I definitely think they're going down. No, I do not. They are going up.
So true and proper tax planning, Jordan, is very important. And again, we know you're passionate about that. There's a difference between tax planning and tax preparation. That's what you offer your clients when they come in to see you for the very first time. And it's why you have designed the Maine Money Report. How often can your clients expect to hear from you? We have about a minute left of the show.
Absolutely. So we don't have one set protocol of a lot of advisors say, well, we'll meet once a year. We have clients that come in every month. We have other clients that say, don't bug us but once a year. So we absolutely let each one of our clients determine how much we want to get to review things. At the very least, we'd like to hear from them every quarter, maybe a phone call or we annoy them with some emails and some videos and things, but the more communication, the better.
Yeah, and I think really the first year you're with us, you're going to be meeting with us a lot more often. But as people get comfortable, that's where every quarter.
Thank you, gentlemen, so much for such an amazing show today. To our viewers at home, we'd like to thank you for spending time with us on the Maine Money Show. We know you have a lot of questions about tax planning. This is your perfect opportunity to call in to gain one of your copies of the Maine Money Report that will be designed specifically for your needs. Be safe, be happy, and be blessed most of all. We look forward to seeing you back 1 week from today on the Maine Money Show, where Wall Street meets Main Street. Take care now.